put the spotlight on Equitas Small Finance Bank. Talk a little bit about Mr. P.N Vasudevan's extended term, the focus on their liquidity position, as well as whether or not business is back to pre-COVID levels. Mr. P.N Vasudevan himself joins in on the show. He's the MD and CEO. Thanks for taking time out. Now, I'm sure that shareholders are surely happy by the decision of staying back with the bank, but I just want to understand what exactly was the thought process, what made you stay back?
So it is a combination of a few things. We had put a search committee. The committee was also in the job of finding a successor. But parallelly, the chairman of the board also was talking to me. And so over a period of time, we felt that, in the best interest of all the stakeholders, this is the best, way to go forward. So that's where we took that call.
So you plan to continue for the next 9 years?
Yeah, subject to God's grace and subject to RBI approval.
All right. That aside then, Mr. Vasudevan, when are you expecting the merger process to be finally completed, and when can we expect the court announcement on the same?
So we had the hearing on 21st of December. So all the documents have been submitted. Now we are awaiting the final court order. So of course we are not very sure when the final court order will come, because these are not informed to us. So we are just hoping that somewhere by middle of Jan, at least we should hopefully get the court order.
Okay, so expecting some clarity when it comes to Jan for the merger and the court order to come by. But let's talk about business as well. Your restructured loan book was around 4.5% in Q2. Since then, has there been any improvement in the performance? Has the restructured book declined further?
Yeah, see, basically the restructured book will keep declining, basically because of some settlements and resolutions, as well as the normal rundown. So, when we started the restructuring, when we completed restructuring last year in the month of December 2021, we had 9.5% of our book, which was under restructured book. Now it's come to under 5%, and it'll keep going down as we go by. And part of that remaining restructured book on the bank, so part of that has already become NPA. The data, of course, was available in the September quarter results, and some of them were in overdue, and the remainder were regular performing accounts. So this thing will keep playing out, but basically the entire restructured book and the impact on the financials of the bank, all that impact has come down substantially over the last few quarters. And I think in the next 1 or 2 quarters, more or less, the impact of that would become, more or less eliminated.
Sure, but Mr. Vasudevan, earlier you had cut your credit growth guidance as well from 30% to 25%, because you had pointed out that there have been some delays in executing the strategic plans of growth outside of Tamil Nadu. Any developments on that front? And for now, what do you expect? Will the credit growth be around 25%? Is it likely to be better than that?
Yeah, I mean, see, we were looking for some growth coming from non-TN states, and there is some execution delay in terms of people recruitment and putting them into place and things like that. But those are now fairly in place, so the growth should come back, and we should see that, for the year we have given a revised guidance of 25% for the year. I think we should comfortably cross that.
Now, given the strong credit growth that we've seen, what is your bank's liquidity position?
Liquidity, there is no issue as such. There's no issue as far as liquidity is concerned. Our deposit growth has been very good. CASA continues to remain fairly strong. Retail deposits overall continue to remain at the 85% odd level. So the deposit flow has been pretty comfortable.
And what is the outlook on your net interest margins going forward, given the rate hike?
Yeah. So the rate hike, we've also been revising our interest rates on deposits over the last 2 quarters in line with what's happening in the market. Currently, we are not seeing a immediate effect on the cost of funds of the bank. basically because these do take a little bit of time, for the old deposit to run down, new deposit to replace with higher rates. So it does take a little bit of lag time. So over the next 2 quarters, we might see the cost of funds going up, compared to what it was in the previous quarters. But overall, the bank, we are also lending into segments where generally we do have the pricing power in our hands. So generally speaking, we should be able to pass on any interest rate increase to the borrowers. And the interest rate increase, even if it's, let's say, 0.5%, from a borrower perspective, it may not be such a heavy burden on them, fundamentally because most of our loans are very small ticket size. And our average lending sides, if you remove the microfinance business, they balance 82% of the advances that the bank gives, which is non-microfinance. Our average ticket size lending is around 4.5 lakhs. So for a ticket size of that, with an average tenure of 3 to 5 years, and 0.5% increase doesn't really burden the borrower too much by way of increased EMI. So generally, we should be able to pass on in a broad sense. So we don't expect too much of impact on the NIM, and I think generally we should be able to reasonably hold on.
Okay, so while the credit cost is expected to go up, you're confident that you'll be able to pass it on to the consumers, and that's why you're expecting that the NIMs will be sustainable at the current levels. But let's talk about asset quality as well, because while there has been an improvement in the asset quality, it's still not close to the pre-COVID levels. When do you expect to go back to the pre-COVID level when it comes to asset quality?
See, our pre-COVID level GNPA used to be in the range of 2.5 to 2.75. It was always in that range. For a long time, it was always in the range of 2.5 to 2.75. During COVID, it had gone up all the way to 4.6. That is the highest that we recorded during the peak of wave 2. And today it is less than 4. It has come to around 3.8 or 3.9. And it should keep trending further down. And I think we should aim to reach the pre-COVID levels. I'm not giving a particular timeline, but definitely in the next few quarters, we should be seeing this downward trend continuing, and we should get back to the pre-COVID level, pretty soon.
Lastly, before we let you go, just wanted to understand if you can break it down for us in terms of which segments are likely to be the growth drivers, which are seeing the strongest traction with respect to credit growth.
So our major business is small business loans, which is loans given for small businesses secured against their house property. That's almost 38% of our book, and that continues to perform well. The demand in that segment continues to remain very strong. The affordable housing that we started pre-COVID, then it went into a lull during the COVID period. Now that has picked up steam, and we have expanded that product into more geographies and more branches. And affordable housing is also now contributing quite strongly to the growth in the advances. So these are the two areas where we see clearly a strong support for growth.
Okay, Mr. Vasudevan, we'll let you go on that note, and season's greetings from ET Now family for FY23, or rather calendar year 2023 to you as well.